How's it going, everybody? Welcome back to the channel. My name is Jay, and today I want to talk about Warren Buffett. For the past 60 plus years, Warren Buffett has been releasing an annual letter to the shareholders of Berkshire Hathaway. And just this past week, he released the 2021 edition of his shareholder letter. Now, this is something I look forward to reading every year because it's one of the few opportunities we have to get advice and wisdom from probably the best investor that has ever lived. So in today's video, I want to go over 5 things that stood out to me from Warren Buffett's 2021 annual shareholders letter. If you want to read the full letter, I will leave a link to it down in the description of this video. So definitely check that out after you watch this. Hit the like button on the video as always, and let's get started. So this passage towards the top of the letter really stuck out to me, and I think it's things we all need to hear. Buffett is talking about his and Charlie Munger's investment philosophy through Berkshire Hathaway. He says, whatever our form of ownership, our goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. Please note particularly that we own stocks based upon our expectations about their long-term business performance, and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers, we are business pickers. Now that seems so basic and so simple, but I think it's something we all need beaten into our head when it comes to investing. Buffett and Berkshire Hathaway don't invest in anything just because they think it might be a good move right now. They're always keeping that long-term view, and they're always looking for the top quality businesses. He says right at the beginning of that passage, he wants businesses with both a durable economic advantage, or a moat, and a first-class CEO, meaning not only does the core of the business and its advantages in the market have to be great, but the leadership of that business has to be great to keep things on track. And that's what Buffett is looking for in an investment. And that's something we should all keep in mind when it comes to our investments. Don't pick stocks because they're hot right now or you think they may go up in the short term. Pick the highest quality businesses you can find and invest in them for the long term. Now, a little after that passage, Buffett goes on to talk about Berkshire's insurance business, and then he gets into another section that really jumped off the screen to me. And that is when Warren Buffett got talking about how much Berkshire Hathaway pays in taxes. He says, every year your company makes substantial federal income tax payments. In 2021, for example, we paid $3.3 billion, while the U.S. Treasury reported total corporate income tax receipts of $402 billion. So the United States Treasury took in a total of $402 billion in corporate income taxes, and $3.3 billion of that came from Berkshire Hathaway. That's nearly 1% of the Treasury's total corporate income tax came from Berkshire. So that must really bother Warren Buffett, right? I mean, who likes paying taxes? Taxes suck. Most people, and especially most companies, will do anything in their power to avoid paying taxes. But Warren Buffett tells a different story. Right after he states just how much Berkshire pays in taxes, he uses the phrase silent partner to describe the US Treasury and its relationship to Berkshire Hathaway. Now, what kind of CEO or capitalist out there thinks paying taxes and having the US Treasury as a silent partner to their business? Most CEOs and most people view the IRS as some nemesis, not a partner. Buffett goes on to say, in fairness to our governmental partner, our shareholders should acknowledge, even trumpet, the fact that Berkshire's prosperity has been fostered mightily because the company has operated in America. Our country would have done splendidly in the years since 1965, when Buffett took over Berkshire, without Berkshire Hathaway. Absent our American home, however, Berkshire would never have come close to becoming what it is today. When you see the flag, say thanks. And that, I think, is an amazing point. What Buffett is saying is that if Berkshire Hathaway wasn't operating in the United States and taking advantages of all our society, our economy, and our government provides, Berkshire would not be close to what it is today, in Buffett's opinion. America, however, if it wasn't for Berkshire Hathaway, America would have been just fine. So the success of Berkshire Hathaway is more due to being in America than anything else. And that is why Buffett isn't complaining or angry about the tax burden that he and Berkshire Hathaway share. So I definitely applaud Warren Buffett for being so level-headed and rational about that. The next part of Buffett's letter that really jumped out to me was the part about Apple. Now, for those of you that are unaware, Berkshire Hathaway holds a massive amount of Apple stock. In fact, it's their #1 holding of companies that Berkshire doesn't completely own. And as of the end of 2021, Berkshire Hathaway owns 5.55% of Apple stock. Apple is the most valuable company in the world, and Berkshire owns over 5% of their stock. Buffett mentions that that stake actually went up even though he didn't invest new money into Apple, because Apple has been performing share buybacks on their own. He says Berkshire's share of Apple has increased from 5.39% to 5.55%. And that may sound small until you realize that every 0.1% of Apple is equivalent to about $100 million in earnings. And just to give you another number that will blow your mind about how staggeringly large Berkshire Hathaway's share of Apple is, Warren Buffett reports that last year, Apple paid Berkshire Hathaway $785 million in dividends. $785 million just in dividends. He says their total share of Apple's earnings accounted to $5.6 billion. Those are just insane numbers, especially when you consider their share is only 5% of the total company. From there, Warren Buffett goes on to talk about some of other Berkshire's larger holdings and how they've been performing, and then he gets to the next section that I really wanted to point out to you guys. It's right under the section titled U.S. Treasury Bills, where Warren Buffett says Berkshire's balance sheet includes $144 billion worth of cash and cash equivalents. Of this sum, $120 billion is held in U.S. Treasury bills, all maturing in less than a year. That stake leaves Berkshire financing about 0.5% of the publicly held national debt. Again, just staggeringly large numbers we're talking about here. Not only is Berkshire holding on to $144 billion in cash, but of that $144 billion, $120 billion is in U.S. Treasury bills. That's 0.5% of the U.S. national debt is owned by Berkshire Hathaway. So if anyone in this country has the right to complain about the national debt or the government spending, it'd be Warren Buffett. Now, $144 billion seems like a lot of cash to be holding on to for a company that doesn't pay a dividend, right? And Buffett agrees. He says that sum and the sum they're holding in US Treasury bills is not some deranged expression of patriotism, nor have Charlie or I lost our overwhelming preference for business ownership. He goes on to say, I always kept at least 80% of my net worth in equities. My favorite status throughout that period was 100% and still is. So Warren Buffett, even at 91 years old, is saying he still prefers to be 100% in equities. The reason that Berkshire Hathaway is holding on to so much cash, he says that cash position is a consequence of my failure to find entire companies or small portions thereof, that is marketable stocks, which meet our criteria for long-term holding. So basically what Buffett is saying there is probably what we're all coming to realize, that in 2021, the stock market was pretty overheated. There weren't a lot of good values, a lot of good deals out there. So instead of just making bad decisions to invest his money just to invest it, like some of us may have done, not naming any names, Buffett and Charlie Munger are perfectly content to hold on to cash until they find the right stock or the right business to purchase. He says that they've endured similar cash-heavy positions from time to time in the past, and those periods are never pleasant, but they're also never permanent. So the key takeaway there is to have your strategy, know what you're looking for in companies that you want to buy, and stick to your guns. Don't make bad decisions out of FOMO. Don't invest just to invest. Be patient and keep your focus. And I think Warren Buffett drives home another important investing lesson, something we should all keep in mind towards the end of his annual shareholders letter here. A lot of the times when you hear about Berkshire Hathaway in the media or you read articles about Berkshire stock, It's always about, oh, has Buffett lost his fastball? Berkshire's lagging the S&P over the past 6 months, or whatever. But the important thing to keep in mind is what Buffett says here. Berkshire, these shareholders would sometimes acknowledge, might be far from the best selection they could have made. But they would add, Berkshire would rank high among those with which they would be most comfortable. And the people who are comfortable with their investments will, on average, achieve better results than those who are motivated by ever-changing headlines, chatter, and promises. Long-term individual owners are both the partners Charlie and I have always sought and the ones we constantly have in mind as we make our decisions at Berkshire. So Buffett says he wants people investing in Berkshire that are there for the long haul, and those are the people he keeps in mind when he's making the decisions. He's making long-term decisions at Berkshire, even though he is 91 years old. But the part of that paragraph that really stuck out to me was that the people who are comfortable with their investments will achieve better results than those who are motivated by headlines, chatter, and promises. And that is so important. If you're comfortable with your strategy, if you're comfortable with the funds or the stocks or whatever else you're invested in, you are going to achieve far better results than the people who are always making moves based on what the Fed did or what the unemployment rate is or inflation rate is, etc. All of those factors come and go and they change a lot. But most of the time when it comes to investing, the best move you can make in reaction to any piece of news or any event is nothing. As Buffett is saying here, a lot of times just being comfortable with how you're invested and holding on will get you far better results. They may not be quote unquote perfect results, but they'll be better on average than if you're always tinkering and toying with your investment strategy. Thanks for watching this. I hope you enjoyed it. Give the video a thumbs up if you did. Check out these videos right over here if you want to see more from me. I hope you do. Thanks again for watching, and I'll see you in the next one.